Why strategy alone is not enough. Most beginners believe that trading success is hidden inside a strategy. They search for it relentlessly. They change indicators. They test new setups. They follow traders who promise consistency. And every time a strategy fails, they assume the strategy is the problem. But this belief is one of the biggest reasons traders never become consistent. Welcome to the Phantom Trader world, where clarity comes before execution. A strategy is not a solution. It is only a tool, and tools do not work on their own. Two traders can use the exact same strategy on the same market with the same rules and get completely different results. This is not because the market behaves differently for each trader. It is because execution does. Most trading failures happen before the trade is even placed. They happen in the decisions you make before the chart loads, before the entry appears, before the stop is defined. Strategy tells you what could happen. Execution determines what actually happens. This is a critical distinction. A strategy might identify a valid setup, but it does not control position size. It does not control emotional reactions. It does not stop you from overtrading. It does not prevent revenge trading. Those decisions belong to you. And this is where most traders fail. They believe that if they just find a better strategy, their discipline will improve automatically. But discipline does not come from better signals. It comes from structure. Structure defines how much you risk when you trade, when you stop trading, and how you respond to loss. Without structure, even a profitable strategy will eventually collapse. Another common mistake is confusing being right with being profitable. A strategy can be technically correct and still lose money. Markets move with volatility. Price does not travel in straight lines. Even correct ideas experience drawdowns. If your execution cannot tolerate that volatility, you will exit early, move stops, or increase risk at the wrong time. And that turns good ideas into bad results. Professional traders understand something most beginners do not. They care more about where they are wrong than about how much they can make. A strategy might define a target, but a professional defines the exit first. Risk comes before reward. Survival comes before optimization. This is why average technical analysis combined with strong execution often outperforms brilliant analysis with poor discipline. Execution is what allows probability to work. Without you never reach a large enough sample size for your edge to matter. You might win a few trades. You might even have a good month, but randomness will eventually expose weak habits. Another reason strategy alone fails is emotional feedback. Trading platforms are designed to stimulate action, fast prices, instant execution, constant updates. This environment encourages impulsive behavior. A strategy does not protect you from that. Rules do. Rules about maximum risk. Rules about daily loss limits. Rules about when not to trade. These rules are not restrictions. They are protection. Many traders avoid risk management because it feels boring. But risk control is what keeps you in the game long enough to learn. Losses are not the enemy. Uncontrolled losses are. Professional traders lose often, but their losses are small, controlled, and forgettable. Amateur traders lose less frequently at first, but when they lose big. This difference has nothing to do with strategy quality. It has everything to do with strategy quality. It has everything to do with execution quality. Another overlooked factor is adaptability. Markets change. Volatility changes. Liquidity changes. A rigid focus on strategy without awareness of conditions creates blind spots. Professionals adjust exposure, not strategy. They trade smaller when conditions are unclear. They increase risk only when structure improves. This flexibility comes from experience, not from indicators. Strategy gives you a framework. Execution gives you longevity. This is why professional traders think in years, not trades. They don't ask if a strategy will win today. They ask if it can survive hundreds of trades. Consistency is not built by finding perfection. It is built by eliminating self-destruction. So when traders ask why they are not profitable, the answer is rarely bad strategy. More often, it is poor risk control, emotional decisions, inconsistent execution. Strategy alone is never enough because markets don't reward behavior. And until your behavior supports your strategy, No setup will save you. Let's make this even clearer. When someone says my strategy doesn't work, they are often describing one of these problems. They take this setup at the wrong time of day. They trade it in the wrong market condition. They change stops when price gets uncomfortable. They size too large and panic on normal volatility. They take low-quality trades because they are bored. Notice something. None of these are strategy issues. They are decision issues. A strategy is only one layer inside a complete trading system. A complete system has at least 5 layers: layer 1, market, and timeframe selection. A strategy that works on a trending market can fail in a ranging market. A strategy that works on a 4H chart can become noise on a 5-minute chart. Layer 2, conditions filter. When will you trade, and when will you stand aside? This is where most people collapse. They trade everything. Layer 3, risk model. How much do you risk per trade? Daily loss limit. What is your maximum drawdown before you stop and review? Layer 4, execution rules. Where is entry? Where is invalidation? What is the exit plan? What will you do if price moves against you immediately? Layer 5, review and improvement. How do you collect data? How do you identify mistakes? How do you update rules without becoming random? Without these layers, a strategy is just an idea. Now here is a simple example. 2 traders follow the same breakout strategy. Trader 1 enters late because they wait for extra confirmation, moves the stop because the loss feels too painful, double size after one win because they feel confident. Result: unstable performance. Trader 2 enters at the defined trigger, keeps the stop where invalidation is real, uses fixed risk and stops trading after a daily limit. Result: stable behavior that allows probability to show. Same strategy, different outcomes. This is why professionals don't worship strategies. They worship process. Now let's talk about why strategy obsession is attractive. Strategies feel measurable. You can test them. You can optimize them. You can believe that the answer is hidden in settings. But the market is not a math problem you solve once. It is an environment you operate inside. And in any environment, your behavior matters more than your plan. A strategy can define edge, but only execution can realize edge. This is also why copying a successful trader rarely works. You can copy entries. You cannot copy experience. You cannot copy how they handle drawdowns. You cannot copy how they reduce risk and uncertainty. You cannot copy how they stop trading when conditions are unclear. Those are learned skills. Now, the deeper point: most bad strategy complaints are actually about variance. Even a good edge has losing streaks. Even a strong approach can have a bad month. If a trader expects smooth results, they will break this system during normal variance. This is where execution becomes the real strategy. Execution is the ability to stay consistent through discomfort. Because you cannot survive discomfort, you cannot survive probability. So if you want to upgrade your trading, don't just ask what strategy should I use. Ask these questions instead. What is my maximum risk per trade? Under what conditions do I stop trading for the day? What market condition is my edge built for? What is my checklist before entry? How do I review my trades weekly? These questions turn trading into a system, and systems are what professionals build. Finally, remember this: the market does not pay you for being clever. It pays you for being consistent. Strategy is the map. Execution is the driving. Without disciplined driving, even the best map leads nowhere. Here is a simple pre-trade checklist that turns strategy into execution. 1. What is the current market state? Trend, range, or transition? 2. Does my setup match this state, or am I forcing it? 3. Where is the invalidation level, and is it logical on the chart? 4. What is my position size if I risk a fixed percentage? 5. If this trade loses, will I be emotionally neutral? If any answer is unclear, the trade is not ready. And this is the final trap to avoid: thinking that more complexity creates more edge. Often, simplicity wins because it is easier to execute consistently. A simple system executed 100 times beats a complex system executed 12 times with constant rule breaking. So upgrade your behavior first, then let your strategy benefit from it. Because in the end, trading is not a battle against the market. It is a battle against inconsistency. And strategy alone cannot win that battle. When you stop searching for the perfect setup and start building a repeatable process, you don't just trade better, you think better. If this video added clarity to how you see trading, support this work. An interaction tells the algorithm this foundation matters. A subscription tells me to keep building it with you.